Good evening. I hope you're doing well. Chances are that in the last few days your portfolio could have seen a correction. This could be perhaps because your portfolio has an exposure to stocks in the small and the mid cap indexes. Trigger for this correction has been a few irresponsible statements by the SEBI chief on market valuation and a requirement for stress test in these indexes. As traders, the triggers for corrections are not very significant. The question is, what is it and how do we plan our subsequent positions? So the chart that I have in front of us is that of the Nifty Small Cap Index of 250, a basket of 250 stocks. And we can clearly see here on this chart, we begin the process of analyzing a chart by only focusing on pivotal highs and lows and form an opinion based on that assessment of those highs and lows. So first is just by marking the high of the chart. I see that the high is around 15,500 and the low of this chart is around 13,300. A roughly 2,000 point correction in the small cap, most of which has happened uh, just in 7 trade sessions. The sudden correction in the small cap has caught many traders and investors by surprise and also created an opportunity or perception of opportunity for many traders and investors. The question is, which side do we see ourselves in? So on the surface we can clearly see that we have a higher top, higher bottom, lower top followed by a lower bottom pattern. This lower top, lower bottom pattern is happening on the daily. So I will just mark this here for quick reference. This is of course the highest top, the point that I've selected here. Followed by a lower bottom, followed by a lower top. This is clearly a lower top, and this is a clustered lower top. So market took several attempts here, and after this lower top we have a lower bottom. So the index has created a lower top, lower bottom formation, clearly uh, giving us sufficient reasons to plan the exit in the index once this lower bottom was broken. So at around 14,200 levels, which was broken just 2 days back, there was sufficient reason to exit most of your holdings from the index, at least from the short term perspective. Now the question is, what is it that we are looking for in order to buy? And even a question before that is, why do we even want to buy this index? The answer, of course, is basically derived from our assessment on the weekly charts. I have covered in the previous videos that if we intend to trade the daily, then our trend assessment, our dominant trend assessment and direction that we intend to play on the security needs to be derived from the weekly. Likewise, if you intend to trade on the hourly, then the dominant trend assessment has to be played from the daily. You have to move up one time frame in order to determine the direction that you want to take in the market, so that you are trading in the direction of the time frame that you are analyzing. We have in the past on multiple occasions analyzed indexes on longer time frames such as monthly and weekly, and in the extremely longer time frame we can see that, of course, I'll just delete this, a higher top was created here, and at the moment we are just seeing a lower bottom. That's largely because the previous higher bottom is here. In other words, in the weekly, this index is obviously still trending. And if we add moving averages here, I have selected simple 2050 moving average. We can see both the moving averages clearly have a golden cross. They both are moving upwards, and the price is pretty close to the 20-week moving average, which is nothing but the first support zone for a trending security. The last time the security tested the 20 moving average, it formed a higher bottom. The question is, will it form a higher bottom once again around this 20 period moving average? That's the question that we are trying to assess. And in case it does, then definitely there is a case for buying securities listed in this particular index. So now we will just move this to the daily charts. this assessment that we have done on the daily charts, because that is the time frame on which we are going to take the trade. So once again, once we have clearly established that the trend is bullish, perhaps bullish strong on the weekly charts because of the multiple reasons that I cited, we, and of course you could use other indicators, etc., but here the idea is just to look at the chart and answer buy or sell. So such a chart is obviously buy. Now the question is on what time frame the we shift one phase lower, and where we actually enter is the daily. Here we can see that the 2050 has been clearly breached. In fact, for to analyze this it is perhaps better to have a 200 period moving average. And now we can see that the 200 period moving average for this particular security is still about 10% lower. But but yes, but do we use the 200 period moving average? I personally do not use the 200 period moving average for my trades. But that is just to showcase the strength of a trend. If a particular trend is trading above the 20 period moving average, so when we come to the weekly charts and we see that the trend is around the 20 period moving average, we will still continue to assess that the chart is strong, that the trend is strong. But in the event we go to the daily chart and see that the price is well below the 50 moving average, then we can be very sure that the trend is either negated or is extremely weak. And in this case, we have clearly established that the trend is negated because earlier we pointed out a series of the first series of lower top and a lower bottom. But our bias is long coming from the weekly, which means that will I short the index? The answer is no. Will I short stocks from this index? The answer is no. I would want to buy the index. So, will I buy the index tomorrow? I will have to assess. And now the assessment here is that the first tactical proof of reversion of any security, the first very tactical proof is the existence of a bullish reversal candlestick. So when we talk about identifying the turn of a swing, there are various established theories. Some of them are to assess for divergences, some of them are to assess for market breadths, etc. But in technical analysis, the fastest method to analyze the reversal of a particular move is the existence of candlesticks. So now from here we can obviously see that the move has is in the downward direction. The move is in the downward direction. The question is, will this move stem? And to stem that move, the first proof of confirmation that we need is that of the occurrence of bullish reversal candlesticks. So now, given that we are at the weekly close and we have seen a very large red candle on a Wednesday, followed by a gap down candle on a Thursday. A gap down would obviously a gap down below the previous low. So I will just mark here. This is the low that I'm talking about. This is the low on Wednesday, and we can see here that the candle opened lower, and when it opened lower, it closed in between the the very big red candle after a gap down. And when a security gaps down after a big red candle and closes in between, at that point in time we say that it has created a bullish piercing candle. So I'll just write this here. This is a bullish piercing. So, what is a bullish piercing candle? First of all, the preceding move has to be downward, which we have established that yes, the preceding move is indeed downward. This is something that was established. Then the next step is there has to be a scary candle, or the market has to be extremely nervous prior to its formation. So we can see the very, very big red candle that was there. The third criteria is that the day on which the bullish piercing is formed, it must open lower, and that criteria is also met. It opened lower than the previous day low. The fourth criteria is whatever number I reached, is that this candle must close in at least at the midpoint of that large candle. So what happens if this closes above the whole candle? Then we have a bullish engulfing, but which is a even stronger reversal pattern. But one step lower than that is bullish piercing, where the closure has to be halfway. And when I take the cursor, so you will see the open, high, low, close on the top left. So when I put the cursor on the day of 13th of March, and see that the high is 14,000 approximately 300, and the low is 13,000 approximately 500, giving an 800 point range. So roughly 400 points is the midpoint of this, which means from the high of 14,300 or a low of 13,500, we need to move up 400 points. So therefore this should close somewhere around the 13,800 to 900 range. And if I move the cursor here, we will see that the closing on the day of 14th, you will see the date on this portion here, on the 14th, which is I think which is a Thursday. The closing is at 13,000 approximately 900, which is spot in the middle. And once we have a bullish piercing candle, the question is that a confirmation for reversal? The answer is no. It is the criteria of reversal, and what it needs as a confirmation is a green closing above the previous day high. And what we have is that the day of bullish piercing is high is 13,900, and the previous day closing is a slightly higher at 13,920. So as per theory, we are seeing a bullish piercing, and we are also seeing a bullish piercing confirmation as per strictly as per theory. And what we are seeing is that the security is bullish trending on the weekly charts. On the daily, it has formed its first set of bullish reversal candles. And when a security forms bullish reversal candles, some people would want to go right on Monday morning and buy the first security that they see. I would not be doing that. Now, I would put two criteria towards it. One of them is on its way lower, or the other one is on its way up. Now, I am obviously, I have a certain set of patterns of my own behavior, and typically, when I see that the preceding move is downwards, I will never buy on its way down, which means that let's assume that on Monday the market opens up in green and corrects little bit. On Tuesday there is another correction such that the market is say at 13,700, which is on the low of Friday. Would I be buying? I wouldn't be buying. I would certainly not be aggressively buying, because we have 10 days of correction. We have a near 12% of correction in 10 days, and the only thing holding it at the moment is a bullish piercing candle. So I would not be allocating all the money in on that particular dip. But if suppose the market goes, so which means I can safely eliminate this process of buying downwards. I'm not going to be buying stocks on limit orders. I'm not going to be buying downwards, which obviously means that I'm going to be buying because of what we assessed on the weekly charts, but I'm going to be buying upwards. This particular security has to move up and break this particular high of 14,300, which roughly means a 3 to 4% move on index. And a 3 to 4% move on index means would translate to approximately 7.5 to 12.5% move on stocks, because stocks would be typically 2 to 3 times the beta of an index. So which means that the stocks I want to buy most likely are trading somewhere 7 to 12% lower than the price at which I am willing to buy them for, or a price at which I will see a confirmation. And now the question is, let's assume that it is a green on Monday, a green on Tuesday, a green on Wednesday, and even a green on Thursday with a red on Friday. Chances are my buying would have started on a Thursday and would be ongoing on a Friday. And then the question is, once I'm buying here, where is my stop loss? My stop loss is obviously the low that did not come into test. That will be my stop loss, which means once I'll be buying at 14,300, I will be having a stop loss at 13,300, which is roughly 7% of the index, which would translate to roughly 18 to 22% of the stock. And if I know that I'm risking 18 to 22% of the stock, and let us say I wish to bet, say I'm just giving a number, say I wish to bet 1 lakh rupee on this hypothesis that a bullish piercing candle on a stock which is trending bullish on a longer time frame, the hypothesis that this candle will hold or will stem the fall and the market will not trade lower. If I'm willing to bet 1 lakh rupee, since the stop loss is approximately 7% away on the index level, approximately 20% away on the stock level, I will only bet 5 lakh rupees, which means that uh, uh, I would know that for every 1 lakh rupee that I'm betting, for every 5 lakh rupees that I place in the market, I will be risking 1 lakh rupee because of the distance at which the support has been created and the conditions under which the support have been created. And now the only question that I need to answer myself at the time of taking the trades would be, how much am I willing to bet at this time? Would it be 1 lakh? Would it be 20 lakhs? Would it be 50 lakhs? How much am I willing to bet? And this is a question that will differentiate one trader from another, and this will be a function of how many stocks the trader is seeing, and how compelled he or she is feeling based on the securities that they're analyzing. So that's it for today. The idea of this particular video was that I would not prepare anything but simply have a go at the chart impromptu, so that the viewers that are there, who have an academic interest in the subject, will see this not as a buy or a sell call on a particular position, but would just see this as as a perspective of one of the many experienced traders that exist. And if this perspective hopefully educates you and adds a layer to your thought process, and benefits you in some way. So with that idea, we will close this video. I wish you the best for the subsequent weeks of trading ahead. Take care.